Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review the global markets, talk about what in the world's going on. As you guys can go ahead and see, these markets are very volatile right now, and we got to be very cautious trading in these markets because there's a lot of unknown factors, a lot of risk, and a lot of factors that we just really cannot consider to be a very safe trading environment overall. Okay, so let's go ahead and get into the charts. Okay, the dollar index has had a bit of a rally today, and you guys do know that the dollar index, whenever it has a pretty decent bounce, markets are generally negative. So going into Monday and Tuesday, I anticipate a lot of institutions to go ahead and unload some of those positions that they already made some money off of going into Friday. So what I mean is basically because a lot of shorts were covering on Friday, the stock markets had a quick bid up. They went up around 2%. But now a lot of institutions will most likely come into Monday trying to liquidate some of those profits that they made on Friday. Another thing to consider is that the US dollar index is going up, and therefore the markets should go lower based on our inverse correlation analysis. This is going to, this right here, this huge bullish engulfing candle has not been able to engulf the previous bearish candle right here, as you guys can go ahead and see. And there is some strong resistance on the 200-day moving average. I find it very unlikely for us to close another day above the 200-day moving average, which would imply basically a sustained rally or confirmation to the upside above a major moving average. But without two trading sessions above it, it's very unlikely these markets could sustain this pop upwards. Another thing to consider when trading these markets is that if it fails, which it most likely will based on the dollar index, since it hasn't been able to confirm to the upside on the dollar index, or on the Dow Jones Industrial Average, since it hasn't been able to confirm above that moving average, a retreating stock market is very weak, and what typically happens is a really nasty reversal to the downside. So again, I really couldn't be a buyer into this market, knowing the fact that this market has not been able to confirm above the 200-day moving average, and you also got to consider the fact that the dollar index is having a pretty nice bounce. Now, it wasn't able to get down to that that 20-day moving average, and basically, it would have been really nice for it to have gone down to that 20-day moving average so we could have really confirmed it. But since we haven't, it's also another good thing because it means that the dollar index isn't as weak as we'd like to think it is. In other words, since it didn't even need to get down to that 20-day moving average for it to find resistance or more like support to go higher, that's very negative for markets overall. Now let's go ahead and look at the Italian 10-year government 10-year treasury bonds. And you guys can already note that we're trading at around a 6.5% yield. Now remember guys, whenever yields go up on treasuries, that means that the value of them has gone up. Well, not really up, but the coupon value of them has gone down. Now what happens when treasury interest rates go up? Well, that basically implies that a lot of banks are closing their bond positions and reallocating capital outside of the Eurozone. And I'll go ahead and show this to you on another chart. But for now, just notice that we hit 7% when we pulled back immediately. Now what happens is that markets don't typically sell off continuously. They usually have a couple bounces. Usually they pull back a little bit. In this case, the yields did pull back a little bit off the 7% level. But but the fact is, just because they got there in general, just the fact that they were able to reach 7% is very negative in nature overall. And we have a really strong uptrend in the bond market. Now, the main reason why this is really bad is because banks typically carry your deposit and they turn around and buy treasury bonds. Now, when those treasury bonds depreciate in value, they are forced to liquidate to avoid losing a leveraged loss. Because technically speaking, when you deposit money into a bank, they are basically borrowing money from you. And when they borrow money and they turn around and invest that money, they have to make a positive return or else they lose a substantial amount of money. And they are obligated to return any money that you deposit into their bank back to you or else they lose their business. So the main reason that I'm trying to point this out to you guys is that since these banks are leveraged and they're borrowing money to make more money off of something, and once that business model fails, they are forced to exit out of a trade. In this case, the Italian, Greek, Irish, Portuguese, and Spanish bond market have continued to go down in valuation, and that deteriorates the value of these bonds. These governments, therefore, have to pay back their obligations at a higher interest rate. And how this works is that basically when the interest rates go up, when banks start bailing out of the bond market, when these governments are at a budget deficit, when these governments can basically have to pay back these obligations, and they have to stimulate an economy, but now they can't. They are unable to. The interest rates have gone up too much, and now they are forced to make austerity measures. Once you put in austerity, you automatically decelerate growth that's already decelerating, because these banks now have to post losses. They have to lose money. They have to fire workers. They have to cut back their loan positions. They can't make as many mortgage loans. They can't make as many car loans. So this negatively impacts the whole entire pig's economy as a total, including the European economy. And you guys do note that the European Union is worth $16 trillion in gross domestic product. They are the most valuable economy in the world. And then the United States follows right after at $15.5 trillion. This issue is almost as bad, if not worse, than the U.S. government defaulting on loans. And do remember that when the Italian pigs, or the whole entire Italian, Spanish, and the whole entire Eurozone, when they default, somebody has to lose all that money that they lent out to these governments. And that implies deflation. And when you have deflationary pressures on markets, the immediate reaction is to sell, close positions, and secure your assets. And what happens? Well, basically, if we go ahead and skip over to the Euro-US dollar chart, the Euro has had a substantial, it has pulled back substantially from 1.42 all the way up to that 100-day moving average. It pulled back. It had a nice little bounce right there. But now I anticipate it to either pull back immediately right now and continue this downwards trend, or pull back right at that 50-day moving, or no, that 20-day moving average just right there. See that 20-day moving average? I anticipate it to either pull back there, or it pulls back now and it continues this longer-term downwards trend right here. And if it continues to go lower and it breaks right below that 1.35 area, anyone could honestly anticipate this market to go all the way back down to 1.32. And if this happens, obviously if the euro gets a decent pullback on it, that means dollar strength, and dollar strength implies deflation. And when you have deflationary pressures on the stock market, trading systems that are automatically traded based upon these correlative factors automatically sell their stock positions, and boom, you have a stock sell-off. That's how markets work. Moving on, let's go ahead and analyze the Euro-Japanese Yen. The Euro-Japanese Yen pair is also pulling back. Today, the European Union has basically said, forget this, I am not holding on to my bond positions. What I am going to do is convert my euros into the Japanese yen and buy Japanese government treasury bonds. And that's why Japan is having a hard time recovering, because there's so many there's so many euros, US dollars, all sorts of currency flowing into Japan, and that Japanese yen continues to strengthen in value as people find the Japanese yen as a great store of value. So the same thing is happening with the Euro-British pound, is happening with the Euro-Swiss franc, is happening with the euro, etc., etc., etc. So again, I think that it's a good idea for European banks to divest themselves, and one of the best places in the world to do it is in Japanese bonds, because the Japanese bond market, believe it or not, is as big as the US Treasury bond market. Japan has a $15 trillion debt, and that's a huge market to loan money into, or borrow or lend to, basically, and secure your assets. And that's what a lot of European banks are forced to do. It's either Japan, it's either the USA, or it's the United Kingdoms or Germany. That's what it is, basically. And you know what? I don't think any bank honestly cares. They just want to protect their money, and they don't want to lose any more money than they already have. Moving on, let's go ahead and analyze another chart, which is gold. I think gold will continue this upwards trend. In times of fear and uncertainty, when there's defaults being considered, every single time that it has ever happened, gold has had a substantial rally in its markets. And it could probably get back to that 1900 area and perhaps pierce it and continue going on to the upside and basically confirm above the 1900 area. I anticipate a much longer term uptrend in gold, because a lot of these banks are looking for alternatives to invest into outside of Greek, Irish, Italian, Spanish bonds. And the best place to put it is in Japanese bonds, US bonds, gold works as well, and a lot of other assets that are much safer than the pigs right now. Moving on, let's go ahead and analyze the final chart, which is the volatility index. Volatility index goes right into that 20-day moving average, and it has been able to find some support. This is very indicative of a bounce, guys. Remember, volatility index goes up when the stock markets go down. Volatility index should get a pretty good bid on the Monday session based on what we're seeing on the dollar index. Let's go back to the dollar index. Dollar index is up. Dow Jones should therefore react negatively and not be able to confirm above that 200-day moving average, and therefore the volatility index should be able to bounce off of this moving average, which is the 20-day moving average, and be able to continue higher to the upside. And that does it for me today, guys. If you guys are interested in anything else, be sure to go ahead and leave me a couple comments, and I'll try to get back to them as soon as I possibly can. And if you guys are interested in my videos, be sure to go ahead and subscribe, as I will have more for you in the weeks and months ahead. Take care, folks.